Good afternoon and a Happy New Year. In light of this weekend's developments out of Venezuela, we thought the fitting theme for today's market discussion would be regime change, not just geopolitical, but across markets and the economy. You're probably aware that the US military completed a special forces operation in Venezuela this past weekend to remove Nicolas Maduro from power and extricate him to New York to face narco-terrorism charges. US officials, including the President and Secretary of State, hinted at further intervention in the Americas to defend our geostrategic interests and stem the flow of narcotics. Farther afield, the US is ramping up rhetoric against Iran, warning their government not to fire on civilians who are protesting an increasingly fragile regime. Much of the press has focused on the energy angle to US actions in Venezuela, and President Trump has spoken about revitalizing the country's oil assets as well. But we think the narrow focus on energy misses the mark. In the shift from a unipolar to multipolar world, the US seems to be keen on reasserting its interests in the Western Hemisphere. Nearby countries that offer inroads to Russian, Iranian, and Chinese influence are likely to face increased pressure from the US, up to and including military pressure. The president remarked this is the Don Roe Doctrine, in a nod to the Monroe Doctrine, named after our fifth president, who wanted to prevent further European colonialism in the New World. Regardless whether one views this as misguided, we think it's a mistake to view it as thoughtless. The US is engaged in global competition with China, and weakening its allies, particularly those it relies on for energy, is a coherent strategy, especially when such nations are in our backyard. So while the short-term market focus may be on the potential to revitalize Venezuela's oil industry, no easy task given its dilapidated state of infrastructure, we think the long-term takeaway is that this is more evidence we're transitioning away from an era of globalization to one in which the flow of goods and services are concentrated within allied blocs. Beyond geopolitics, investors will be looking for signs of regime change in markets this year. To start, will technology and tech-related sectors like communications continue to dominate in the years ahead? Tech plus communications now comprises 45% of the S&P 500's value, surpassing the concentration in 2000. To be sure, these are key sources of both profit and innovation. The benefits of that innovation, however, should begin to diffuse to other sectors in the form of improved operating efficiencies and higher margins. Similarly, will we see a regime shift in the concentration of market cap in the top 10 firms? The largely tech-heavy top 10 US firms in the S&P 500 now comprise over 41% of the index and account for 32% of its earnings. So there is a fundamental driver to the valuation expansion. Perhaps this can continue expanding indefinitely, and we're truly in a winner-takes-all economy where large-cap tech wins everything. As we just stated, though, we think it's more likely that in the coming years, we see earnings growth begin to accelerate for firms benefiting from the introduction and spread of new technologies, such as AI. In such a scenario, we'd expect this ratio to decline gradually as a result of better performance outside the tech sector. If, however, non-tech firms fail to realize material benefits of innovation, then the economy-wide spending on tech services and infrastructure is likely to fall and bring down this ratio in a more volatile fashion, as investors will likely stop rewarding the leading tech firms with premium valuation multiples based on high growth expectations. As the big get bigger in the S&P 500, the S&P 500 has gotten bigger across global markets. S&P stocks now account for over 65% of global market cap. While the US does have a unique tech sector, we do not have a monopoly on innovation, economic growth, and well-run businesses. Many foreign markets with good growth prospects trade at valuation multiples of 5 to 10 turn discounts to the S&P's 24.5 times forward earnings. We think considering international allocations is prudent in the years ahead. Finally, will this be the year we see a permanent regime shift in the capabilities of artificial intelligence? Right now, AI is on its own accelerated Moore's Law path, where its capabilities are currently doubling every 7 months. The most capable coding model, Anthropic's Claude, is now able to undertake tasks at a 50% completion rate that last up to 5 hours. Many programmers contend that coding tools from the leading AI labs have become so good that they can write close to 100% of their code. It's likely that similar advances arrive across other industries in the coming years. We're skeptical that there will be a massive employment upheaval as humans have a good track record of finding new ways to utilize new technology to do new things. But the short-term impact could be volatile. Our guess is the nature of work changes across many industries to one in which humans become managers of AI tasks and focus more on creative aspects as compared to the mundane. If so, this promises to increase productivity, which would be a welcome economic change, especially for the US, where it could offer a gradual way out of our long-term debt predicaments and improve real wage growth and living standards. Lots to ponder as we enter the new year. As always, please feel free to reach out to discuss anything we covered and investment opportunities. Thank you and have a great week.